So we'll start by defining the vision, if that's okay. And Allan, if we can start with you really quickly, considering you left us with such pearls of wisdom. When we talk about finance for the common good, are we describing a completely different financial system, or can we reform what we have? What does success actually look like when finance truly serves society rather than just shareholders?
You know, when I was in graduate school in economics, there was nothing in my training that related to the financial markets. Financial markets were considered basically a function where the intermediation between savers and investors efficiently moved capital around the system to support the real economy. And in the years since then, finance, unfortunately, I think has become an end in itself. And I think that a system that has finance as an end in itself is a system that is flawed. And that has to be faced. And the second thing, of course, is the metrics for measuring performance are wrong. And they led to really perverse outcomes in the market, and that needs to be addressed.
Agreed. Anyone else would like to weigh in here?
Well, actually, yes. I would like to add on that, and in specific on ESG funds. Because if we look at them as a proxy for impact investment, we can see that in the US, there were outflows of funds from ESG funds. And in the EU, where this term effectively was coined in the last 2 quarters, we also see that investors are withdrawing the money. Same kind of sentiment is in Asia as well. So, you know, there are several reasons why is that, but one of them is that ESG is a broad label and it's not measurable. And the investors have a stronger preference for something where impact can be quantified and measured more accurately.
Thank you. I wanted to keep this wisecrack for later, but since we've brought in ESG, you know, DEI and ESG, while they're TLAs, 3-letter acronyms, they're becoming 4-letter words in the US. Completely agree. I was a program director on a Article 9 fund, which is a huge ESG climate-focused fund. That was back in 2002 when we launched it, and yes, it's difficult to find capital for those funds. Vladimir?
Well, I want to defend finance here. It's a finance conference, especially the future of finance. So I would start with a joke because Allan saved us a joke. So we have a finance guy, experienced trader, and a customer. And the finance guy says, your money and my experience will become my money and your experience. And I would say finance provides a lot of common good of teaching people experience. And this experience is quite important for the growth of the human mind. You need some sort of an objective connection between skill, effort, and outcomes. And financial markets provide that on a daily basis. And in the process, both select and develop better humans.
Thank you. Siddharth, you've done so much on this.
Yeah, I would, just to add a different perspective, I think there's, at the core, and I don't come from a financial background, but have been building technology at population scale in the context of finance. And I think there's something powerful where, at the end of the day, finance, when done right, and if it's thought about as a means to an end, has a very powerful impact on the lives of individuals and small businesses on the ground, because they can fundamentally use finance and different financial instruments to grow their business, advance their life, transact with each other in their own economy or across borders, protect themselves when things go wrong. And so the real question is also, how do we scale financial instruments, financial access to 8 billion people, 300 million businesses. What does that look like? Because obviously there are primitives within finance that are very valuable to individuals and businesses. And so I think that's something that we also shouldn't lose sight of in the broader picture.
Thank you. I'd be remiss if I didn't ask you to quickly shed light on what you've done and what Finternet Labs is all about, just so that people can contextualize everything you're saying.
So I've been part of the team that over the last 15 years, we've built a few infrastructure projects. So closer, yeah. So we built a digital identity system and scaled that out to 1.5 billion people across the world. 1.4 billion was in India, another 100 million was in 10 other countries. Then they went on to build out a payments protocol because the identity system was used for opening of bank accounts. So 500 million bank accounts were opened. And we saw firsthand how, this is a simple example. If you had traditionally extrapolated the KYC paper-based form opening rate, in India that would have taken about 50 years. There's a BIS study on this. But using technology that got done in less than a decade, so 9 years. So you shaved off 40 years of developmental timelines because of a technology intervention without risking financial stability. I think that's the other side to it, which is if you use technology the right way, traditionally it's thought of as financial inclusion and financial stability are at odds with each other because you lower your norms to increase access. But you can actually use technology again to bridge that trade-off. So we built identity systems, built retail payment systems that's used by 500 million people and a whole bunch of other what I would call purpose-specific infrastructure. And then in 2023, we met with Augustin Carstens and realized that we needed a newer imagination of moving away from very asset-specific, jurisdiction-specific, sector-specific infrastructure to a lot more general-purpose financial infrastructure, but specific flows. So property, securities, money can all be represented. Each one can have their own rules, and that's what we published as the Finternet paper last year.
And it's all not for profit.
Yeah, so we've set it up as a foundation structure. We have a network of labs around the world.
Funded by a grant, a corpus?
Different philanthropic donors. So
Great.
we have a lab in the US, one in Switzerland, one in Singapore, and one in India.
Well done, well done. So on to the next question. Virginia, I was wondering if we could start with you on this. So obviously you're at the EIB and you've experienced financing projects that balance returns with social impact. But what are the biggest practical barriers that prevent people in finance from serving the common good? Is it misaligned incentives, regulatory gaps, or simply that being good doesn't pay that well?
Well, I think when there is an intention to invest, there is an intention to get a return. And some projects, let's say, there is a market gaps because they don't seem to be profitable, palatable, attractive in any way to the investor. So I think multilaterals really do a lot in a way to make these projects more interesting. What I mean by that is providing instruments such as de-risking, portfolio guarantees, or risk transfer, such as, let's say, synthetic securitization, where effectively we provide a guarantee on an exposures. In that way, the counterparty can release the capital and utilize that capital to, let's say, further on lend if we are talking about banking and institutional alternative finance, and lend to the riskier clients. So this is sort of, you reduce the risk and the project seems much more interesting. And also EIB's participation, just because we go through very extensive analysis, due diligence, also gives a comfort that we really went through the process with a fine comb.
Thank you. Thank you. Alan, you'd already covered the buffer the U.S. government provided long-term capital management, LTCM, back in the day. Are there any other examples of the regulators stepping in? Virginia mentioned about the ECB guarantee.
Yeah, the official line is that uninsured depositors are on their own. But in reality, every time there was some crisis of one size or another, the restriction on providing coverage for uninsured depositors somehow was gotten over. The biggest failure since 2008 was Silicon Valley Bank. Silicon Valley Bank had a very, very concentrated deposit base, which in fact made the bank vulnerable to a bank run, notwithstanding the availability of deposit insurance. And somehow they managed to work that out so nobody lost any money, if I remember correctly. So, it's just another example of privatizing profits and socializing the costs. And
that's a great phrase.
Yeah.
Thank you. Siddharth, from your perspective in India, what does the government cover any retail or institutional faux pas like this?
So I may not be best placed to answer that, particularly, again, that I look at this from the vantage point of a technologist, but there is a mix. So India's financial sector, about 50% is public sector governed. And so therefore the state plays a larger role in their functioning. 50% of the sector is privately driven. And so there you have a lot more market forces and animal spirits playing out. On the bank, and we have different regulatory setups for banking, capital markets, insurance, pensions. So each of them have their own regulatory authority. And what we've also seen is that, so for example, our central bank was formed even before India got its independence. And so there's a lot of dynamics that play out in terms of how the sector is governed and how you operationalize things that are unique to that.
And interestingly, it was called the Reserve Bank of India. Just by the nomenclature, it was all about creating reserves for if the worst was to happen. So we'll stick with you, and yes, I will ask you a technology question then, thinking of technology as an enabler, Siddharth. You're building infrastructure for a more inclusive financial internet. So can technology democratize finance and make it more equitable, or does it risk creating new forms of exclusion? How do we ensure that digital finance innovation benefits everyone, not just the digitally savvy?
Yeah, so I think fundamentally, my view is technology, when deployed at population scale, can actually bridge the digital divide. We often think of it as causing a digital divide. My view is you can actually bridge that trade-off. Now, technology in some cases is an enabler. In some cases, it is finance. If you look at the developments around crypto, Bitcoin, Ethereum, a whole range of other crypto assets, you're fundamentally now dealing with, because of technology, a new class of financial assets, financial instruments being created, over and above, of course, technology being an enabler to scale out access to finance to people across the world. And so I think it's going to play an even more critical role as, by default, billions of people are so comfortable with transacting on the internet, and that's setting their expectations of what they expect from the financial system. And so that behavior change, and so far you can't support that using existing rails that are there. It's really difficult, it's very costly, especially when you try to do it across different types of financial assets. For example, Allan in his previous presentation spoke about the need for, if I would frame it, we call it observability, and observability of the truth. Today, essentially in the financial system, you're observing replicas of the truth. And therefore fraud is buried in that paperwork. Technology allows you, because you can't do random sampling using technical systems. For example, UPI or any real-time payment system, UPI does 600 million transactions a day. there's no way you can send manual examiners to look at even a % of it. So that allows you to now create natively observable systems and then enforce regulations and compliance on top of it. So I think there's one, technology acting as financial instruments, and then technology as an enabler. And there's a whole body of work in each of these.
Thank you. Very profound. Vladimir, we'll come to you on developing capital, including that of the humankind. So how do we measure success when the goal isn't just profit maximization? What data and metrics we can use to hold financial institutions accountable? And how do we encourage young minds to develop into happy, high-performing team players?
Well, I mean, again, back to the idea of truth. And yesterday there was one of the Lithuanian entrepreneurs said it's very important for the culture for everybody to own or be accountable for their mistakes. And I believe exactly both an institution or an individual, in order for them to flourish, they need to have a clear causal link between I did something, there is a clear measure of what I did, and then I can calibrate if this measure, this outcome is a bad outcome, whether for somebody else or for me. And this is something that I think financial markets, financial systems, financial operating system in the mind provides to both companies and humans, is the potential for direct connection between your own effort. So you don't socialize losses and privatize benefits. You privatize both benefits and losses. And in this particular world that has a little clear-cut measures of performance, I don't need equitability anymore. I need equal access. And the differences that this equal access generate actually will improve performance for probably most people. Now, they're not going to be equal, but they're going to be at least proportional to their merit or to their skill or to their technology access or whatever. So as a result, I think the promise of an objective measure of performance that potentially financial markets provide is immense. Now, systems get perverted, systems get pretend measures of objective performance, and this is a thing where potentially people will say, well, financial is a corrupt system. It allows people to mislead, to cheat, not own their performance, not operate in a clear causal link between actions and consequences. So here is where a good regulating system or a digital system will ensure some sort of a more correspondence theory of truth than our imperfect world currently allows.
Yeah, just building on that, I think to what you said, it comes down to human agency, right? Mm-hmm. Fundamentally, it's about giving individuals and businesses their agency over their own financial life, where they have the ability to carry out what they want to carry out. They're not restricted by, I want to do this, but then, oh, is the bank open at this time? Or can I do it? No, it requires a minimum X worth, or so on and so forth. And you're constantly facing hurdle after hurdle.
Or is it safe? Can I carry the cash with me?
In many cases, exactly, right? You look at island countries that are suffering from de-risking, they're all falling back to now having to physically transport cash through boats. And, you're just raising, at the end of the day, what happens, particularly the brunt of this gets borne at the retail individual level. I mean, if you look at it, the ones that have technically the lowest default rates often have the highest interest rates just because of access problems that take place and the inability for those individuals to prove that they're trustworthy vis-a-vis a large corporate, for example, right? So it really just comes down to human agency and giving individuals that agency over every aspect of their financial life. And I think the second point that I quickly want to mention is at the end of the day, there's also human behavior playing out. Right? And so human behavior will always have good and bad implications. And I think a combination of both public authorities, but also now with AI coming in, you will see more interesting tools that can allow you to manage fraud, like social engineering fraud and all of these other types of fraud much better. So there might be a whole new support system of tools that could, again, empower individuals over and above institutions leveraging them.
Very well said. Thank you. Virginia, if you can bring you in, and given your quasi-regulatory hat on, from a governance and oversight perspective, do we have the right standards in place? And what can we do to do more on regulation without stifling innovation?
That's a good one. Well, do we have a standards? I think we're getting there. So, for example, for the financial institutions, we as the bank, we look, when we go through the due diligence of the counterparts, we look at TCFD reporting and the ability to disclose, and then we see if the client, let's say, doesn't have the capabilities. We provide technical assistance to them how to implement this type of financial reporting, and we do it for free. There's no hidden cost. There is no strings attached. So I think the demand is that, as we discussed, there is need for more tangible benchmarks, and because of this necessity, there is also a way being developed. How do we get there? How do we measure more accurately?
Thank you. Anyone else on governance, standards, measurements? No. Any questions from the audience? Nope. Anything on corporate responsibility to various stakeholders? So it's easy to measure shareholder value, but not so much in relation to societal goods. And the two can be at loggerheads. And Virginia, you did touch on that. But how do we align executive incentives? We'll start with you, Siddharth, if that's okay, from being the head of a foundation. Have you been in touch with any CEOs, and how have their incentives been aligned based on what you're doing?
Yeah, so I think, for example, on the emission side, we're doing work with Oxford University as part of an effort called e-liabilities. And that's basically how do you represent emissions in a provable manner, and represent sequestration of carbon in a provable manner. And there's a body of work that's happened on how you can build this on top of the accounting system. So there are some of these examples to address the double counting fraud that typically happens, say, in ESG and so on. That's interesting. I think the larger question, at least the way I look at it more systemically, again, from a technology lens, is one of the things we've also been thinking about is what if you democratize ownership to everyone, right? So, for example, this was a conversation I was having in London recently, where you have local hospitals raising funds through municipal bonds. And now typically those bonds are not purchased by retail individuals. It ends up being purchased by some private equity firm, right? And they have no vested interest in that region. And you see that factor playing out. You look at ETFs, etc., where there's no voting control of the end investor passing through, or end communities passing through. And that's just because traditional infrastructure makes it so expensive. Because how are you going to manage, some small retail investor having voting control on a whole bunch of these decisions at scale? So one of the things we've been thinking about is what if an individual could allocate, part of their pension funds portfolio where it could be allocated to those bonds in their community, and a subset of them may go on to actually participate in board discussions and, drive some amount of reforms. So similarly, when you look at ETFs, where technically those are really proxies because voting control is not transferred through, I think there's a lot of interesting ideas there. So we've been really looking at it from the lens of what are different use cases where you could create technology that democratizes the tooling to make more responsible behavior, more verifiable behavior, and so on.
Wonderful. We look forward to seeing those use cases. Oh, there is a question. Please go ahead, David.
I would like to ask Mr. Allan Mendelowitz to clarify his opening statement where you seem to have been not happy with two aspects of the finance discipline or the way it is used. Remember, there was your beginning statement
I'll rephrase the question.
Okay.
Thank you.
Yeah.
In the beginning, you said you weren't happy with two aspects of the financial discipline. I think they just want some rationale and justification behind what you said.
Oh, you know, I don't know what I think about something till I hear what I have to say about it. And to be honest, I can't put myself back in that situation, but I can tell you that my concerns really go to the implementation of the metrics in financial performance. You know, I would say the current system where the single metric is the earnings per share on a quarterly basis is so unfortunate because it ignores all the costs associated with externalities. It represents a system which over the past 50 years has systematically shed corporate responsibility to any interest other than shareholders. And we're left with a metric of performance that I view is akin to going to an art exhibit and giving out ribbons based upon the based upon the frames around the pictures, rather than the pictures themselves.
Brilliant analogy. Thank you, Allan. We're almost out of time, but just to balance the airtime, last word, Vladimir.
I don't need to be balanced. I just said that you don't need different equal outcomes in the world. But I want to go back to this question about incentives. And I see there is an urge of almost any human nature to get undeserved gains. So let's say I'm a CEO. I want to manipulate earnings. I want to boost my compensation. And to some degree, it may actually start with either the market or the shareholders or the government trying to prevent or preempt this desire to get undeserved gains. And one possible start would be from early childhood education, that undeserved gains is not a benefit. It's not, if you earn something that you didn't work for, potentially is not something to strive. So easy money is something that you should be concerned for. Hard-earned money is something that you can be happy about. So I would also emphasize that a good portion of the problems in finance may actually come in from early education, and potentially that's one way to go as regulators.
Thank you. Very well put, and a great way to sum up. All I'm going to say is we need economic development. We need finance for the common good, as is the topic, but we also need financial enlightenment, that nirvana that we all want to achieve. Thank you all. Oh, speaking of enlightened, I'll invite David Stollen back on stage. Thanks.